All right, good evening, everybody. It's Ken of Tortoise Capital. This is the Sunday night strategy session. So, I have already recorded the speed run Friday night and then the detailed review of the daily report earlier this afternoon. Those are both on YouTube under the public distribution channel and also links on Patreon. So, I'm not going to recover those unless you have specific questions about them. So there's just some things that I want to cover in a more general way now that we've gone through 2 full weeks of effort and more desert ahead. And so I wanted to make this more of a longer term view and a philosophical discussion. But I, of course, will answer any questions that you specifically have. So if you have any things you'd like me to cover tonight, go ahead. Chunk them into the text or into the question window there. What I'm going to tell you is also, for sure, I'm going to do the weekly sessions this week. I intend to keep going as long as they're needed, but certainly, no matter what, for the week ahead, all the way through the next weekend. I have a June streaming only workshop scheduled for Van Tharp and the folks in Cary in June, and I'm going to be accepting questions from folks who are going to look at the boot camp videos and then ask me questions about our trading style. I'm going to give them links to the videos to the last couple weeks of strategy, so they're going to be sending me questions about our current understanding of the systems and the techniques. And so if you're in the sound of my voice, I want to invite you to submit questions too, and I'll roll all that into the ongoing material I cover. I just feel a need to get everything as updated as I can to help you with the development of your trading plan. So what I just want to talk about some top level concepts tonight. The first one is on the screen there. That is a picture of a 20 mule team crossing Death Valley Desert, pulling 2 giant wagons and a water buffalo. We call that water container there a water buffalo. Carries about 600 gallons of water. And the 2 guys on the wagon there are mule skinners. And Mark Twain said the freest men in the world he'd ever met were mule skinners and riverboat captains, because nobody could tell those guys anything because they were such masters of their craft. So here's what those mule skinners, these mule team drivers, have to do. They've got to, they're going to take those wagons all the way back to Kansas City, and they're, oh, I'm sorry, I got to show you the screen, don't I? I need to show you the screen. Sorry. I was showing screen 1 instead of 2. Sorry about that. So those are mule skinners right there. So they started in Kansas City, and what they were going to do was go mine borax, which is a chemical used in industrial manufacturing just about everywhere. But it was really being used back in the Northeast in the expanding industrial economy of the North. And so these guys would go to Kansas City and get their mule teams and wagons, pull them all the way across the Great Plains, over the Rockies, into Death Valley, where they would mine borax, and then they would load up those giant wagons, pull them back across the Rocky Mountains, across the desert, across the Rockies, across the Great Plains, all the way back to Kansas City, where they would put them on flatboats and then float them up the rivers till they get back to New England. Now, the passes through the Rocky Mountains were such that there were hairpin turns on those mountain trails, and they were so sharp that in order to get the wagon around that hairpin, at some point you would have to put the first 2 mules around, then the next 2 and the next 2. And at some point, the mules, because you could only bend the traces so far to the right, you would have mules suspended above a 2,000-foot drop, and they wouldn't fall because they were in the traces, and the weight of the other mules and the wagons would be sufficient to keep them from falling. So imagine how good you have to be as a mule driver to be able to convince a mule that it's a good idea for him to suspend himself in space 2,000 feet above the ground without resisting. And then you have to get over the mountains, across the desert, over the Great Plains, all the way back to Kansas City. So these guys knew something about their craft. And that's kind of how I feel about trading all the time, the mentality that it takes to really be an independent individual is to have the courage of your convictions and the skill, because you got to have both, and the willingness to keep doing what needs to be done. And you can imagine that there were a lot of people in Kansas City and New York and all points in between telling you why that couldn't be done and never get it done. And these guys were doing it and making a living at it because they could do it. Not for everybody, but then trading's not for everybody either. And it doesn't really matter what other people say. It's what you do. So I try to keep in mind these mule skinners. And Mark Twain's writings on these guys are pretty amazing. So here's just a sense of a sketch we did in one of the boot camps. We're just trying to describe the power of certain ideas in the RLCO framework. And so I want to just, if I can, talk a little bit about that. Let me see. I can take a picture of that so I can sketch on it a little bit. That's what I want to do. Stand by. Well, just follow my my mouse cursor here, if you will. If you can just bear with me for a New York minute. Yeah, it's not. My screen capture's not working. Okay, so what I want you to notice is that we have a z-score ladder here. We have a positive z3, z2, z1, z0, and that equates to the Bollinger Band mean. Z minus 1, the southern edge of the river. So this idea is buying P1 and selling z2 on a trade frame. So what I want you to imagine is after some kind of like a morning hook or a sell-off where it goes outside of Z1 and then it finds some kind of support level. Now whether that's at a previous day's low, 10-day low, 30-day low, a Z3, a VWAP, a previous support and resistance, any kind of support level that makes a suggestion to you that this extreme move to the south has stopped and is starting to reverse. I've shown that here as something like an RLCO P1. That could be one of the things that happens. So there is a certain vertical entry price zone where you have found any reason that satisfies you to get in, and you are south of Z minus 1. So you're outside of the river. You're already in the land of abnormal excursion away from the mean. And you have some window of time in here where you saw the swing low. Maybe it was a doji. That little plus sign is a doji. And then maybe between the doji and the RLCO1 pattern, you could also say maybe that's an owl pattern too. I would update that by saying maybe that's an owl. Anywhere between the lowest low of the sell-off in the form of that little doji perhaps, and all the way out even to the owl. Somewhere in that time window there is a reason that you have chosen that you believe it's okay to act. Then what I want you to notice is that the idea would be, as long as you're buying somewhere in or around Z minus 1 or slightly below, you can think of the price ladder that goes from Z minus 1 to the Bollinger Band mean to the far side of the river to Z plus 2 and then all the way to Z plus 3, the other red line on the far side of our little framework. I would love for it to get to a Z3 objective price target. And maybe that's the range stat. If we found the low of the day and added a range stat to it, we might find it up there around Z3. That would be the maximum reasonable intraday move. So that Z3 line is the one that we can use to compute the 2-to-1 favorable reward to risk. I will just tell you that if you have seen a price that gets beyond Z minus 1 outside the river and then turns around and makes an RLCO P1 or a 1, 2, 3, you are going to have a 2-to-1 available move just to get back up to the Z3. You can add the range stat to it, and that's fine. But you don't have to worry about, can it really move that far in a day? Yeah, yes, it can. It can move that far in a day. So now I want you to tie this to the idea of the 2R battle drill. So Z2 would be the objective price target for the 2R battle drill. That if we had this sell off and a reversal and a Z-score entry, maybe it's an owl or an RLXD or a pocket entry or a 1, 2, 3, or it's moved a frog box off the bottom, whatever, or a minimum manageable risk box, some amount of manageable risk that you're willing to take that you see more than 2-to-1 to the upside. Well, when you layer that on a RLCO framework, you end up seeing these Z-scores as an adaptive price ladder. Now, as you go through time, if volatility is increasing, if the size of those little minute bars are increasing, then you will see the space between the price ladder expanding. But if things are starting to calm down and it's a reversion to the mean truly, you might actually see, the river compressing and this Z ladder starting to compress. And so how much it compresses after each bar is going to be a function of mathematics and statistics, but it's going to be an adaptive process. So when you set your initial target, you're aiming for Z3 or Z2, you just got to remember that thing is going to decay through time, and that's what this line sloping 45 degrees to the right may be. So let's just suppose that you got a entry at Z minus 1, and then it instantly went to Z2, and you cashed it. You would have this perfect vertical trade that you got everything that you wanted to get in 0 time. Now, how awesome would that be? You would have 0 seconds or 0 minutes of open risk. So let's imagine that in some time, whatever the time frame was from the lowest low to the time that you entered, if you doubled that and then you saw your move back up to this decaying Z2 target line, you might call that first arrow a really steep retracement. It goes to the Bollinger Band mean and outside of the river and all the way to the far side of the floodplain. You might call that an A trade. And then a B trade, if it was something like a 45-degree angle and you got Z1 out of it, so you picked up 2 Z-scores. You went from Z minus 1 to 0 to plus 1. So maybe something in here is a B trade, and maybe a C trade is between 0 and 1 in terms of what Z-score you get. And then maybe a D trade gives you something where you got no lose plus dinner for 2, and then an F trade might be something where you got a scratch trade, or you let any of the positive gains go, and then you end up losing money on that trade. So you might think of these scores as something like, how fast is this thing confirming that the hypothesis was true? So the hypothesis was nothing more than a science project which said, is this thing going to go back to Z2 or Z3? Is it? Or is it going to continue to fail, which is what caused it to have that adverse move to the downside anyway. So as you're watching the day unfold and you're watching your trade unfold, you have something like this template in your mind that says, that gives you a little sense of detachment from the trade, right? It's saying, remember, this is just a science project. You're just an investigative reporter. You're a detective to discover what kind of a trade this actually is. It had the potential to be any one of those trades, but it's turning out to be the actual trade that it is. So then you might use this kind of notion to ask yourself the question later on, where did I exit compared to the original trade frame? If I was originally entering here and aiming for Z2 or 3, and then I ended up getting one of these, how would I classify this later on? And how much did I give back from the maximum favorable excursion? So once you start seeing each one of these trades is nothing more than an experiment, and your result being an experimental record of one data point that you're going to add to the database of this science project, the easier it is to kind of get over that sense of ego and ownership and the need to be right. And really, it will help you make a dispassionate decision to exit when the rules say it's time to exit, or when it's just not following through. So this buy the P1 and sell the Z2, it's my belief you can make a living between the Z2s. Like if something sold off all the way to Z minus 2, and then it started to reverse, and then you bought it at Z minus 1 with a 1 Z-score trailing stop, well then you would be trading from Z2 to Z2, from minus 2 to plus 2. That's 4 Z boxes, if you will. And you're giving up one of them as your initial risk, and you're aiming for 3. So from Z2 to Z2. And most of the time you'll see that market oscillate in between those. So what that also tells you is any excursion that goes beyond the floodplain, it doesn't even have to get all the way out to Z3 to be amazing. It's anything beyond Z2, and you sort of have a special condition already. Only one time out of 20 does that excursion get beyond there, and it doesn't stay there that long. It will start snapping back towards the Bollinger Band mean, which is adaptive, it's true, and that's why you have to take into account how the changing volatility starts making those Z-score ladders expand and contract. So I'd like you to think about that, adopting that kind of mentality for, the science project, if I may say it that way. When I first made the daily report video today and early this afternoon, the futures were up big, and now they've gone limit down already. So this is not a good thing for tomorrow. So I was saying, hey, tomorrow might feature a 5% move up at the open. It's already limit down now. So we're going to be ready for a lot more volatility, even though the Fed just said dropping another 50 basis points down, or however much, was down to 0, and going to pump another $700 billion, but the market replied with limit down. So yeah, the Fed funds rate is cut back to, so it's 100 basis point cut all the way to 0. That's all in. I mean, the Fed has just said, oh, it's going all in, but that's money going straight to banks and trying to prop up large portfolios. We'll see what that does. And I want you to notice something, if I can find that chart. If you take a look at where the indication is for the open, there was basically in the last few minutes of the day, see if I can find it here. Yeah, here we go. Yeah, that's what I'm going to try to show the Dow 30 here, sorry. Yeah, so if we look at the this little period in the last 30 minutes of the day with all that volume, it went from about let's see, 22 even to 23,175. It's gonna open somewhere down around here, so that all of that rocket ship gains and all that massive volume. Again, I'm not a conspiracy theorist, but if you had insider knowledge that the Fed was going to take massive action over the weekend, and you thought that the markets were going to really respond to that, you might try to load up with a bunch of volume in the afternoon after a 5% gain, and then that pumps it another 5%, and then you're hoping for Fed activity and then a big gap open on Monday, and not so fast. So there's going to be a bunch of guys suffering tomorrow at the open with the limit down open. So we'll see how that happens. But that's why I can't really trade. I can't put any information value into that last half an hour, and especially going into the weekends. Like I said, any swing trade positions I have are ones that were paid for and are deep in the money. And so if you listen to the speed run from Friday night, a lot of those swing trades, almost all of them that I had that I held overnight, all got hit higher than where I wanted to exit from. But it was without hesitation getting out of those. To quote our mentor, Robert Gardner, I would rather be outside wishing I was in than inside wishing I was out. So I am really glad I'm not in this market with a short position trying to get out of it. And that was going into Friday. And then by the same token, I did not want to be long over the weekend, because this could just as easily have been a limit up move if the markets had interpreted another 700 billion and rates going to zero in a positive way. But there's enough negative news out there that that's not the way the market is voting right now. There's little to nothing in the U.S. response to managing this crisis that suggests calm. So that's what I want to say about that. Let me see what else we got here. Yeah. Okay. Here's a couple. Here is a template that I use in the day trading course. I just want to reinforce. My favorite daily template, or the way I look at the potential price action of each day, is that this this blue bar here is the open, and this blue bar here is the close. So whatever the close was, from yesterday, and then here's today's open. So this is what the gap stat measures, is the difference between yesterday's close and today's open. Now, there's an open, a high, a low, and a close. So the fail stat on the daily report is the one that takes the last 30 days and finds out what was the percent difference, what was the percentage loss on average from the open to the low of the day, whenever that occurs. And then it expresses that as a percentage. So then the idea is, if this thing gaps down, sells off, and then starts to roll back up, and if it has already made a fail stat, maybe this really turns out to be how far it goes on average, and now you have a potential move from the low of the day on average all the way to the average high of the day. So the range stat then takes the average range of the day plus one standard deviation, and then whenever you see a working low of the day, and then you add that range stat to it, that's what gives you the theoretical maximum reasonable intraday move based on statistics. And then 85% of the time, 5 times out of 6, it will not, in the past 30 days, it did not move longer than that. Only 1 time out of 6, or 15% of the time, did in the previous 30 days did it exceed a range stat move. So we use that as the maximum reasonable intraday move. Then the fade stat is when you've got the high of the day, and how far does it sell off on a percentage basis to the close. And then that sort of gives you an idea of if I've seen the low of the day and I have something like a range stat move to the top of the day, and this thing is starting to roll over, and I'm running out of time until the end of the day, maybe I just want to I just want to cash that in order to avoid the expected average move all the way back to the close. Yeah, that's what I'm trying to do. Oops. Sorry. Stand by. There we go. So that's what you think about by the fade stat and the fail stat and the gap stat. That's sort of then this little move here from the open to the low to the high to the close. I call that my favorite one because that's the one that looks like a morning hook. You know, it had a sell off, it had a gap down, then sold off quickly, and then started that 1, 2, 3 rehearsal, and then from the low of the day, as I start thinking about how can I get into that position, it might be, hey, that's the low of the day, and then there's a 1, 2, 3, and maybe there's an RLXD entry up in here where the RL10 crosses the dragon, and maybe there's a P1 inside here. You know, the 10-period regression line has crossed that, and maybe there's an owl entry, or maybe it's just a frog box move off the low of the day, so that's just one frog box. And so my job is really just to find some reason among all of those reasons to get in, and then you can think about that first template I showed. And then if I'm aiming for the far side of the river, Z1 or Z2, or even a range stat, I can now start classifying the move in those terms. As long as I can have a not crazy reason to get in, and then can manage my risk and get to no lose plus dinner for 2, then I can get out of this position without having to believe in it. I just want to get well started, get my risk out of it, and then just see as a science project how much it wants to give me. So that's the basic attitude that I take towards that daily frame and the daily trade. Okay? Okay, so the next one I want to talk about real quick is just this one. That when I go through the daily report myself, what I'm looking for are symbols to prepare. So this is the kind of the cheat sheet that I use to go for my daily report, which is a salad bar of many different styles and symbols and systems and time frames and whatnot. But when I'm thinking about making my daily trading plan for the next day, you know, like day one technique, core and turbo, if you will. What I'm looking for is this, where I'm looking for any new signals from any patterns from the swing trades, like 5-day down, washout, triple screen, etc. And I'll just write those symbols inside here as things that I'm going to prepare. I might take a look at my strategies and styles, which are more relaxed approaches to finding categories, like max pain range compression or max gain range compression, the pinch and stretch report, the squeeze report. I might look at the ADX report to see what things are really exceptionally trending, to see what I might want to follow through on. Symbols that come to me as a result of, say, the MACD 4 Seasons or the Auto Framer or the RLFF, Regression Line Fractal Framework. And then under continuations, any trades that I had already done that day that seemed to close well, or I had made some money on, or there was a certain, powerful move made and I've already invested in the different price levels for support and resistance, I might put those in there. I will use an analysis of those symbols in column 2 under market condition to get a sense of what the global markets and then the regional markets are doing with volatility, the U.S., some of the big internationals, Brazil, Mexico, so forth. I'll take a look at what the other asset classes are doing as potential alternate areas to invest in: treasuries, real estate, precious metals, oil. I'll look at what the U.S. sectors are doing, the XL series. And then I'll take a look at all the frog champions all the time, every day, no matter what. And then from that list, once I've gone through the daily report and made any notes on there that I want, I can then start constructing the individual trade frames for any of these usual suspects. So 90% of the time, the trades that I'm taking are coming right off of this kind of a standard sheet, and then my preparation allows me to build out the specifics on the trade charts. Okay. This was a smart sheet that we built in one of the workshops, the live trading workshops, where somebody was using this to just make their own notes about market as we would go through the daily report in this sequence. Any insights about market classification or annual condition, 10-day condition, range stats, gap stats, all that stuff, the mechanical signals, and then coming down to do a quick sketch on logic chains to show how you would get from the market to a sector to a particular stock of interest. So this was kind of operationalizing the intraday plan. And then scenario trading would be, what do I do, or what is my plan if the futures are going to have a big gap, a small gap, or the market looks up or looks down? How am I going to use that to start prioritizing certain targets to look at? And that helps you get squared away right from the opening. And then I had guys making notes on, what is your plan for the opening, for the morning session, for the lunch, for the afternoon? What are you going to do about the close? How and when might you think about holding things overnight? And then these were all ways that we could construct our elevator speech for the trading plan. And then we just use this kind of trade log sheet here to say, what was the source of the trade? Was it a symbol or a strategy or a continuation? What was the symbol, time of day? What was my entry, my initial stop, the target I was aiming for? What was what risk percentage of my portfolio was I willing to take? How many dollars were invested in that R, and then therefore what was my position size? What kind of decisions did I make? What kind of exits did I get? What was the R multiple? And any comments about that trade? So when you're trading a lot of things intraday, that's sort of an expedited trading log that lets you just quickly capture all of the most important elements of information. This is another form of that with an example of some logic chains that people might use to get from SPY. If it was the negative day, they wanted to go to, and if they were worried about finances, say this was the top little sketch right here, you might start with the S&P. Then if it was up and then XLF was up even more, the financials, then that might lead you to Bank of America, JP Morgan, or American Express. But if the market was down and financials were worse, in this logic chain, you just went to SKF, the double inverse, or the triple inverse, I forget which one that is, and then you might play that. The international ones, you might say, hey, let me go with, if the markets are up and long, maybe emerging markets or Asia less Japan or EFA might be doing better than the S&P, but otherwise the inverse emerging markets with the EEV. That might be one you'd be interested in for tomorrow, I'm thinking. And then the same with technology, where you have the Qs and maybe some different companies that might be the target. So this was an example of short, quick logic chains that would allow you to quickly find the mover and then get it done. So I wanted to share that one with you, and I'm going to upload those in the in Patreon, and then you can also get them in the handout section in this one. And then I'm updating this one for that course in June that I'm going to do, where I'm going to go through each of the pieces of the daily trading plan, and then talk about what those little components are on the dashboard, and then explanation of how they're produced and so forth. And then that's going to be part of the basic training or boot camp for the techniques that we use, and that will help us, I think, get a better look at the at how to leverage the daily trading plan for our own use. Okay, so I'm going to hang. I think I've already hung that one in the. No, I haven't hung it, but I'm going to hang that one in Patreon when I get this updated. It has some changes I got to make. Last time I did it was 2013. It's been good till now, but I've made enough changes this year that I want to update that. So that's going to be coming for you for the boot camp. Those will certainly be done this month. I'm going to try to get them done this week, and so you have that to look forward to. Okay, so I think that was everything I wanted to cover tonight, unless you have any particular. Oh, I'm sorry. Here's one more. So as I start thinking about, the range of tradable patterns, in this was just my quick sketch. I think of the RLCO first generation. That's where we identified particular patterns in the between the RL10 and the RL30 and the River and the Bollinger Bands. And we identified P1 through P7, and we talked about what the Dragon was. After a couple years of working with those, we've actually refined that into what I call the second generation RLCO, where we talk now about owls and pockets and the Z3 pinches and the P1 failures and chain trading, the regression line crossing the Dragon. These are all refined ways to enter specific trades. And now for me, the P1 through P7 and the Dragon are simply descriptions of the price action that's going on, but the actionable, better ideas are coming out of the second generation. There are a few other things that are just miscellaneous, like 1, 2, 3 entries and exits, morning hooks, failure to fail further, failure to follow through, highs of the day and lows of the day, that are supplements that are not necessarily part of RLCO itself, but are really trading technique that we've developed. And then the frog with the hybrid frog has really replaced, in my view, the structured mechanical leapfrog, quick frog, and slow frog. The hybrid frog that I now teach, I believe, is very good stuff. And then finally, just certain techniques that help, like regression line fractal framework is a way to frame trades, to find trades, to execute trades, but also to describe price action in relative terms. It really does a nice job of helping us estimate reward and risk that's available longer term in trades of any time frame. And then things like the market classification indicators of slope stat, alpha stat, and the stretch stat help us understand more details about the trade market itself, the market conditions, the ideas of the minimum manageable risk box, the ready, fire, aim technique, and then the ambush that comes out when you have no directional bias, when price is compressed into that super pinch. And you can think of that, setting it up like an ambush, that when it surprises us and goes in either direction, how can we be prepared to take advantage of that? And then some of the things that we talk about in trade management that you'll hear in the debriefs and in the chat room and whatnot. The no lose plus dinner for two, the Zeno stop and reverse, 2-hour battle drill, parabolic stop and reverse. And I've already just talked earlier today about these stats: gap, gain, fail, and fade, failure to fail further, failure to follow through, the core and turbo. A lot of this ended up becoming the text document, the 37 strategies, what we mean by these as definitions and how we use them as strategies. So get the 37 strategies document that's in Patreon and that's also in the chat room and many places, and start working your way through those. So what the boot camp materials that I'm preparing for the new guys for June, number 1 section is going to be how to read the daily report and get the most out of it. And I've shown you the first draft of that. And then the second one will be me talking through each of those 37 strategies, which includes a lot of this material here. But that sort of represents the ecosystem of trading ideas and concepts. And I want to just highlight that you don't have to master all of them to trade any of them. You got to find the ones that really resonate with you. And when I see guys like Kim and Joe and Jerome adopting these ideas and getting paid for the ones that make the most sense to you, you can't see the image. Why is it not showing? Yeah, you should see just like a handwritten sketch note. Reminder, how about now? So just more to follow. Really, what I'm really saying on this one is I will the 2 documents to study will be the 37 strategies document, and then the document that shows how to read the report and get the most details out of it. So you can find just those things that really matter to you and for you. And again, you don't have to master all these things. All you got to do is find the ones that resonate with you and master those techniques, and then trade on your terms, and then add as you need to. But really, focus on that handful of symbols and patterns. And I just think Joe and Kim are really figuring it out. Just watch the things that they're posting. watch how they're getting it done, and that is the way ahead in my view. So we got a big week this week. The I think the market volatility is going to crest this week. Don't know what direction it's going to be. The Fed's already all in, so there's a ton of money running in there. These are the times that try men's souls, and so focus on the specifics. You don't have to be right. You just cannot afford to stay wrong too long. So the speed run is done. The daily report is done. I'm going to leave it to you then to get prepared, and send me your questions, and we'll just keep getting after that again all week in this room with that registration link. That's going to be good for the whole week to keep coming back to the standard room. So that's everything I wanted to say there, and I'll process this one and get it uploaded on Patreon also, in case you find anything there worth listening to again. So I got a little more philosophical and strategic today, but I feel like we're going to be well prepared for tomorrow and for the week ahead. So take good care of yourself. Make sure you're getting lots of rest, and take care of the things that matter. Okay, so take good care, guys, and we will see you in the chat room.